We start today's market talk. There is always a gap between ground zero facts and fundamentals on one hand and stock prices on the other, because the latter captures the potential of facts and fundamentals changing in future. But when this gap widens far more than warranted, things get challenging and a dash of honesty is needed. You may all recall there was a UK PM for a very short time called Liz Truss. When what she did, she became the PM, she had cut taxes that jeopardized British fiscal policy and how the bond markets remind with surging yields that it cannot be done. So what happened? She cut the taxes just to become popular, and the bond markets raised the bond rates. So telling her that if you're going to cut taxes, there is going to be higher fiscal deficit. Hence, we have to have higher yields. And she had to bow out rather unceremoniously from office. Right now, the US bond market is at sea whether to worry about inflation or recession. It's a very important point. I'll show you today how the US bond market is behaving. They're not sure. And it is to be seen whether the US bond market would discipline Trump administration, because there is a dire need to show some integrity to valuations also. For India, honesty has already begun at home. Now, coming to market outlook, Trump's tariff threats are a prelude to negotiations, but far more significantly, he believes in a world split up into spheres of influence by the great powers. He eyes a bigger, better trade deal with China. That is the kind of indication he has given. He wants a deal that would include substantial investments and commitment from China to buy more American products. It certainly doesn't mean that there will be an end to rivalry between US and China, but the Cold War rhetoric may be lower. Now, US administration stands to end geopolitical conflicts, Middle East, Russia, Ukraine, etc., is positive for equity market sentiment. It should support stability in commodity prices, especially crude, and would be aiding margins for India Inc. Dollar index after a steady rally has started retracing. Again, you have to watch dollar index also, which should be positive from perspective of return of flows to emerging markets. Now, support for Indian equities continues to dwindle with allocations collapsing to a two-year low. China allocations, on the other hand, are at two-year high. This is basically due to DeepSeek shining the spotlight on the remarkable strides made by Chinese technology companies and Xi Jinping's recent meeting with tech leaders in China. So there is a lot of fund flow which is now taking place to China, and they are selling off other emerging markets. A combination of high valuations, low growth, and a weakening currency is leading to a shift of funds out of India and shift to markets which have faster growth potential. Just for your information, since October 24, FIs have sold 2.93 lakh crores. Unfortunately, even after this decline, India remains an expensive market. And over the last 12 months, global investors have poured roughly $520 billion into US equities. Now, I'll just show you something. If you see here, this is the Nifty quarterly PAT growth year on year. So if you see here, from a high due to base effects in Q1 FY24 of 35%, it has significantly come down. And now for the last 3 quarters, it is at 4-5%. Now, if it is 4% or so, first in Q1, we gave a reason of elections. Q2, we gave a reason of monsoons. And Q3, which is supposed to be our best quarter in terms of festivals and so many other issues, there is no growth. So that's why people are losing their patience. Now, if you see the earnings growth, what is expected after a very good FY24, of 25% or so is around 5% in FY25, but that can also be because of high base effect. And then it is expected to rebound around 10 to 14% over FY26. Now, the most critical point is that to be seen if retail investors continue to maintain their faith in small cap and mid cap stocks. Now, a lot of money was moving into them, these funds which are dealing with small and mid caps, and that drove up the valuations. But right now, the PE ratios of small and mid cap indices are 27 and 35. That is, mid caps are still more expensive than even small caps. Now, investments made in recent months may not be generating positive returns currently. Unless corporate earnings begin to grow more rapidly and US yields start to decline, foreign investors are unlikely to return to India anytime soon. Why US yields have to decline? Because right now at 4.5%, 10-year yield gives a safe 4.5% return for anybody to put money in the US, totally risk-free. And if you come into emerging markets, there is a currency risk of 3-4% every year. Hence, unless the US yields don't decline, then chances of FIs coming back to India or any other emerging markets is slightly less likely. Now coming to US markets, US markets slipped as sentiment took a hit due to weak economic data. Russell 2000 already is below 200 EMA. CBOE VIX index jumped to 18.5. US services PMI contracted first time since Q1 2023. And US 10-year yield drops as traders seek safety from stock market. I'll explain this when I'll explain the US 10-year yield, that how it is impacted on both sides. And Fed has also signaled that there would be no more interest rate cuts. Tariff developments and weak guidance from US consumer bellwether Walmart have also lowered the sentiment. Trump said that he will announce 25% tariffs on import of cars, semiconductors, and pharmaceuticals. Now, this will cause higher inflation. Impact of tariffs on US economic growth is not clear to the markets, and US Treasury spending is expected to exceed its revenue because of higher tax cuts, etc., and higher tariffs. So, widening fiscal deficit as Trump administration promises tax cuts is the one which is going to worry the market. The good part for them is that since dollar is the reserve currency, foreign investors have no alternative other than US bond markets, where it comes to investment as a safe haven in periods of uncertainty. So now let's see the dollar index. Dollar index, from the low, it had retraced more than 61% and then has come down from there. And now it is below the 50% retracement level. And now it is at 20 EMA. So from here, if it goes down, it will be positive for emerging market. If it goes back up again, then we will have to watch. So right now, the dollar index is correcting because people have realized that tariffs are more of a negotiation tactics and not that kind of actually it will be put. So dollars are, or the money is not coming now into the US as it was coming early in January, etc. Now USD INR, it had come down to around 88 level, but then after the RBI action, it has come down to 86.56 of 6 level, and it remained there throughout the week. So probably the RBI action has given some kind of stability to the currency now. US 10-year yield, it was going up once the Fed said that there would not be any rate cuts and there is an inflation concern. But after the recent data on inflation and growth, so if there is not going to be any growth, the yields are coming down. Another reason is as people start moving out from equities and start buying bonds, there is more demand for bonds. Hence, if there is more demand, less supply, the yields come down. So this is also could be one of the reasons the US yields are coming down. But if you see both US 10-year yield and US bond dollar index are at 20 EMA, so at very critical level. So we'll have to see from here what happens. Brent crude is correcting, which is good because of lack of uncertainty regarding the geopolitical issues. Gold continues to move up. This is basically because of safe haven buying. And now if you see, it was on this trajectory, then it shifted to a higher trajectory, and now it has shifted to another steeper trajectory from the 20 EMA. So we have to keep watching this, but this is where the money is moving in now. Copper financial futures, no change. So probably this is end of the month, so people will be closing their positions, etc. So no, not much of demand is expected here. Bitcoin also is right now made a kind of a doji, so nothing much here, and it is not showing any kind of momentum as such now. Nasdaq dropped 2.26% last week, basically on Friday only, based on the weak economic data. And also it has become expensive, though it made a fresh high also last week, sorry. Dow Jones again is correcting and has now come down to 20 EMA on the weekly chart. So same reason, but still it is on an upward trajectory, making higher highs and higher lows. Now coming to India VIX, this is a weekly chart. So if you see, it went up, but it has corrected also. So now it's at around 14 odd level. It corrected around 3.26% as most of the events are over now. So volatility should reduce, but if the market corrects and more people buy puts, the volatility goes up. Now, this is Nifty 50 if you see the weekly chart. Now, these are two declining trend lines. There's a lower declining trend line and upper declining trend line. So it is respecting that. And if you see here, it is right now poised at the declining trend line and made a doji here with a higher upper shadow. So that means they were selling here and it couldn't sustain the price here. So this is now at a very critical level. Now, if you see on the daily chart, if you see here, an attempt was made over the last 7-8 sessions to make a bottom here. But in my opinion, it seems to be now surrendering, and it has gone below this 22,800 odd levels, below this. Now, if you see here, why 22,800? Because after the after the elections, this 23,000 level was proving to be before that also a resistance, and then it finally took off from here. So this was the first swing, then it corrected a bit, and this was the second swing, which took it to the all-time high. So generally the market corrects by two swings back. So it had come onto this level. Now if this level breaks, then maybe 22,000 or below can be expected over a period of time, not immediately. So we'll have to see these kind of things. Now, but what is happening is the prices are breaking this level line and indicates a further fall. Only way to avoid this is for the market to regain this 22,800 level firstly very quickly next week, and then try to build up, at least go above the 20 EMA, that is 23,140 odd level, above this, and then try to take out this 23,350, 400 levels. What is happening, as I've shown you, is that every quarter we have been hoping for profit growth, but these hopes are getting dashed, and that is why there is a continuous bound of selling at every rise. Now, coming to hourly chart of the Nifty, so if you see here, this was the last low, and this was made on 17th. Then the market tried to go above, but then it couldn't sustain above even the 20 EMA on the hourly charts, and then throughout it took resistance there, and then finally broke on Friday and made a fresh low of somewhere around 22,730 odd, and then closed slightly higher, but it could not break 22,800 also very convincingly on Friday. So in my opinion, if which is most likely 22,750 breaks, then hope for don't go long till the time, this 22,750 or 800 is taken out. Otherwise, it will be heading lower. Right now, it is not even oversold. So Monday's opening thing would be one which should make it oversold. Nifty Bank was the stronger index. Again, it made a kind of a doji only, and you could see it couldn't sustain above the 50 EMA on the weekly chart. So it is again looking weak. Last low was 48,000, so this is still protected, but it is looking weak as such because other than HDFC Bank, other banks are selling off. Now, this is a daily chart, so if you see here, it is range bound and it is below the 20 EMA on the daily chart. So right now it is weak. For some strength, short-term strength, it has to go above the 20 EMA. It tried to go, but it has failed. HDFC Bank, the daily chart. So if you see, it is very precariously poised at the 200 EMA, which is at 1680. So once this breaks, then it will go and test this 1625 level where it last took support. So that should take the market down. Similarly, Reliance. So if you see here, it tried to bounce from 1200, but couldn't break the 20 EMA. Hence, it is below that only. So once this 1200 breaks, then maybe lower levels are possible. So this again 1200 has to be protected well. Midcap Select, again, this is one index which I was talking about going short because you get more moment here. Last week it was range bound, gave a moment on both directions. So I think it should head to this 10,400 odd levels because that is where the low of the election day was made. So that should be the first logical target. So once this heads, then this is tested. Then again, you may see a up move. But for a better up move, it has to trade above the 20 EMA, which is very far. Now, small cap index has came down and tested the level of election day low. So that is critical level, and it bounced up from there. So now we'll have to watch if 15,000 holds from here. Now I'll cover two stocks today. Sorry. First is JSW Energy. It generates 6677 megawatt of power, out of which 3158 megawatt is thermal power, 1391 megawatt is hydropower, and 1461 megawatt is wind, and 667 megawatt is solar power. They are present across several Indian states and have stakes in natural resource companies in South Africa. KMPCL, which is KSK Mahanadi Power Company, a 3.6 gigawatt coal-fired power plant in Chhattisgarh, which includes 1.8 gigawatt of operational capacity and an additional 1.8 gigawatt in brownfield expansion potential, is to be acquired by JSW Energy for rupees 15,990 crore. So that has most of the approvals have come. Estimated net present value for JSW Energy 74% stake in KMPCL is to be around 27 rupees per share, factoring in the brownfield expansion. Acquisition price implies rupees 8.9 crore per megawatt price which they are giving, which is significantly lower than the recent ordering price of rupees 12 crore per megawatt by NTPC. So they have got it cheap. It's very simple. You divide this 15,990 by 1,800 megawatt. So you get 8.9 crore per megawatt, because that is the operational capacity of this, or that is 1.8 gigawatt is one which is operating. The balance is a brownfield, so it has to be developed. So they are paying 8.9 crore per megawatt, while NTPC is ordering price is 12 crore. So they got it cheap. This highlights relative cost effectiveness of this acquisition. Now coming to their results, if you see, they are expected to grow around 20% from here year on year, normal. And EBITDA is also expected to, as a percentage of net sales, is expected to improve. So that means the margins will improve. Their problem is their interest payout, because that is increasing. So if you see here, in FY26, they are expected to make an EBITDA of 8,300 crores and the interest payout is 3,000 crores. Now this interest payout is fixed and 4,238 crore in FY27. But this is variable. Something can always go wrong, right? Government may give them lesser rates or something like that, or that development may not take place. So if this EBITDA goes down, then there is a problem because rate of interest is fixed, so that payment has to be done. So this is a problem with this stock. Now, as per their estimates, the profit after tax is expected to grow around 26% and then remaining flat because of higher interest payments, which are expected in FY27 because they're doing so much of acquisition, etc. Now, their problem, if you see their balance sheet, is their loans. So they have a loan of 36,820. This is a capital intensive business and the cash flows are not that good to sustain the business. So that is the problem. So the debt to equity has gone up. Now, if you see here, FY27 expected, it can go up also, is roughly around 2. Now, one of the reasons for fall of various infrastructure projects is higher debt. Now, if you see FY25, they are expected to around 13.7 EPS and FY26 around 17. So keep taking a EPS of around 17 with decent business in all kind of fields related to power. It should be somewhere priced at 30 times around 5,100, etc. Not beyond that. After that, it becomes expensive, or you are paying too much into the future for whatever is going to come. Now, ROEs, etc. is improving. Fixed asset turnover, etc. is low. So you see, you're spending money, but asset turnover is below that. So it is not an efficient usage of capital which is taking place. Net debt to EBITDA is rising, right? For this year, it's 6.1. Next year, they're expecting it to be 5.1, come down. They're expecting higher EBITDA, basically. Debt is not coming down. And debt to equity is rising. So that is a concern. So installed capacity is improving. So roughly around 8 gigawatt now. Capacity breakdown, they are in thermal, wind, hydro, solar, hybrid, etc. Everything. Consolidated EBITDA is expected to grow. So, but this is always this is the best case scenario, and ROE, ROC are also improving. But the problem is here. If you see operating cash flow after working capital change is below the capex for FY25 and 26. It only goes above the capex requirement in FY27, but these are too much in future, so this has to be confirmed. But debt is a problem, so EBITDA you have to watch their EBITDA every quarter. Moment there is a problem, the stock will correct. Net debt to equity is high, and consolidated net debt to EBITDA estimated, so immediately is around 6.1. So that means whatever operating earnings they are having, it is 6 times the debt right now. So, or debt is, 6 times the operating earnings. So there is a problem. That means they will have a concern, and they will have to borrow more in case they have to expand or buy some other. And this whole premise is based if they don't do any other buyout or buy some other projects, etc. Now, this is Motilal Oswal has done some SOTP based valuation based on their thermal capacity and giving 9 times multiple, hydro book value wise, and then renewable again, and green hydrogen, etc. So they have come to a figure of around 705, which I feel is slightly, and they have some stake in JSW also, which has been included, which is slightly on the higher side. In my opinion, around 500, 520, 30 should be the fair value. Anything below that is an opportunity, and above that is expensive. Now, this stock, if you see here on the weekly chart, see it retraced 61%, exactly 61% it retraced from the high. So this is what I was telling, that most of these stocks which are expensive will retrace 61%. So it retraced that, came down and tested the 200 EMA on the weekly charts, and then based on these upgrades has bounced back. So these are not the level. The level to buy would be somewhere closer to this 410, 415 levels from where the bounce had come, because these levels will again be tested. Otherwise, there is no point buying it expensive. Next stock is PTC Industries. Now it is setting up the world's largest integrated single-site titanium materials and casting facility in Lucknow's UP Defense Industrial Corridor. The facility includes an aerospace material plant which will have 5,000 tons per annum EBCHR, that is electron beam cold hearth remelting mill, 1,500 tons per annum VAR, vacuum arc remelting mill, and 200 ton per annum PAM, plasma arc melting mill, covering all three basic titanium melting remelting technologies. It is also setting up a 600 tons per annum super alloy vacuum arc melting mill. WIM PAM will commence operation by fourth quarter FY25. That is next quarter. We'll have to see if there is some improvement in revenues, followed by EBCHR in second quarter or third quarter FY26, which indicates strong top-line growth prospects in FY26-27. Work for the 600 tons per annum airspace casting plant has begun well and is expected to be commissioned by third quarter, fourth quarter FY26, along with hot rolling mill. Value-added products, titanium, aerospace casting, and rolling mills, forging plate and sheet are also expected to commence operations in second half FY26. It recently commissioned India's first and largest vacuum arc remelting mill to produce aerospace-grade titanium alloy ingots. Now, every time it commissions something, the stock goes up by 4,000-5,000 rupees. I'll show you on the chart. During the quarter, the company also completed the acquisition of the UK-based Track Holding, which will complete the entire titanium product value chain for designing, manufacturing of precision-engineered parts such as turbine blades, nozzle guide vanes, heat shields, and turbine segments, finding end usage in civil and defense aerospace, power generation, and naval gas turbines. During second quarter FY25, it acquired a hot rolling mill to manufacture value-added product plates and sheets from titanium ingots, with the addition of the hot rolling mill and machining plants. The company will achieve a fully integrated, vertically integrated titanium capability. Given the high moat and entry barriers, sharp earning growth, and a superior ROCE, it will trade at a significant premium in years to come. Titanium alloys are critical for aerospace industry and biomechanical applications. So this is basically a play on defense, aerospace, and biomechanical applications from various industries, because titanium is supposed to be the lighter and superior metal as compared to steel. Now coming to their quarterly performance, there's nothing great. So if you see here, sales were up 20% year on year for the third quarter, but for 9 months, it is just up around 1%. So nothing much. Remember this 186 crore here they have done in 9 months. I'll show you what is expected in FY25. So the margins have come down quarter and quarter because they have hired a lot of people for future performance, future working, high capability people that they have hired for working in this titanium related industry. So that's why their costs are higher. Employee costs have gone up. If you see here, employee costs have gone up because they are hiring a lot of people. So that is the reason margins have come down. Profit before tax is better because of other income. Otherwise, it would have been lower. So if you see, EBITDA is at the same level, but profit before other income of 10.2 crores has helped the profit before tax part. Now, coming to this, so if you see here, they're expected as per the company 411 crore, while in 9 months, they have done 186 crore. So how can they really double this? So this will be brought down. So this estimate will be lower, hence EPS etc. will also be lower. Now, what is expected is that these guys will double their or add around 900 crores to their revenue every year. So it will be roughly around 3,000 odd crores in FY28, and simultaneously, because of this, the EBITDA, etc., will also go up, and profits will also go up. So they are expected to do around 940 odd crores of profit and EPS of around 600, 613 FY28. So FY27 again. But you have to see, right now it is not showing. So the revenue is expected to grow in 100% in revenue, EBITDA, PAT, etc. is supposed to grow like that. PE, obviously, if you're counting around 500 rupees also at for future at 10,000 bucks right now, it is at 20 times, but that earnings have to be seen on ground. ROE, etc. will improve. Very surprisingly, there is no debt. So I went through complete issue. I didn't find any debt assets. So how, and there are no cash flows also. So how are they doing all these acquisitions and all? I don't know. I have to get into that. And margins, etc., are supposed to improve. Now, their current business is based on basically industrial and defense casting group. So they have this part. Then aerospace casting group, so where they do casting, titanium, superalloy casting, and controlled microstructure casting. And then aerospace materials group, forging and rolling mill, titanium alloy mill, superalloy mill, etc. So this is the present business. Now, if you see here, this stock in 23 was around at 5,000 bucks, gone up from there. And then in 24, they did an acquisition. So from 7 odd thousand, it went up to 15,000. Then it corrected. And then once they announced this track holding acquisition of the UK, then the stock went up to 18,000. This they announced in January, and it went up like that. After that, it has corrected and has come down to around 10,000. So it is very difficult. So from within 2 months, from overbought, grossly overbought, it has become oversold. So people have booked profits or people have got out. So this is very difficult stock to track because the quarterly performance doesn't indicates the kind of euphoria which is there as per the analyst and the research reports. So these are the kind of stocks which one has to avoid in a bull market, because those who have bought here or on this upward trajectory may never get their price back. And it can easily trade if the performance is not there. So at any smaller valuations also, because if you see here, this is, if they do around 30-40 bucks also here, because if you see in the 9 months, they have done 24 rupees. So at this rate, if they do around 35 or 40 also, FY26, so at 40 bucks, maximum it can trade at 50 times is around 2,000. So market will take these stocks down very quickly if there is no progress or something is not there. Plus, the other point is why this issue has become highlighted, or titanium capability is required, because the largest producer of titanium in the world was Russia, and the Russian supply was not coming to the world. Now, if the Russia comes back and starts supplying, now the demand will reduce, etc. And a lot of all these natural titanium deposits are in Ukraine, etc. So that constraint was there. So one has to be careful with these stocks. I've finished. We'll take questions now.